The central banks just made a move that changes everything. And if you're not paying attention to what's happening right now with gold, you're about to miss the biggest wealth transfer of our generation. Because here's what nobody's talking about. While mainstream media keeps telling you inflation is under control, while they're celebrating every small dip in consumer prices, central banks around the world are quietly accumulating gold at a pace we haven't seen in over half a century. They're not just buying a little here and there. They're buying in massive quantities, over 1,000 tons per year. That's not normal. That's not routine portfolio rebalancing. That's preparation. And the question you need to ask yourself is simple. What do they know that we don't? Think about it. These are the same institutions that control monetary policy, the same people who have access to economic data before it hits the news, the same central bankers who sit in closed-door meetings discussing the future of the global financial system, and they're converting their reserves into physical gold at record levels. The World Gold Council just released data showing central banks increased their gold reserves by over 44% compared to previous periods. 44%. That's not a trend. That's a stampede. And when you look at who's buying, it gets even more interesting. China, Russia, India, Turkey, Poland. These aren't small players making symbolic purchases. These are major economies fundamentally restructuring their reserve positions. Now let me show you something that should make your blood run cold. The COMEX, which is the primary exchange where gold futures are traded in the United States, has been showing some very unusual activity. The ratio of paper gold to physical gold has been expanding. What does that mean? It means there are more claims on gold than there is actual gold to deliver. It's like a game of musical chairs, except when the music stops, most people are going to find out their gold doesn't actually exist. And here's where it gets really interesting. Commercial banks, the big players who typically short gold to suppress prices, have been quietly reducing their short positions. They're covering. They're getting out of the way, because they can see what's coming. When the commercial banks who have spent decades keeping gold prices contained suddenly start backing away, you need to pay attention. Let me take you back to 1971. August 15th. President Nixon closes the gold window. The United States officially ends the convertibility of dollars to gold. At that moment, gold was $35 an ounce. Within 9 years, it hit $850. That's a 2,400% increase. But here's what most people don't understand about that period. It wasn't just about the price going up. It was about a fundamental loss of confidence in fiat currency. The same thing happened in 2008. When Lehman Brothers collapsed and the financial system nearly imploded, gold was around $700 an ounce. By 2011, it had nearly tripled to $1,900. And that wasn't speculation. That was fear. That was people and institutions realizing that the system they thought was stable was actually built on sand. Now look at where we are today. We've got global debt at levels that would have been unimaginable even 20 years ago. The United States alone is carrying over $34 trillion in national debt. That number is so large it's almost meaningless to the average person. But here's what it means in practical terms. There is no mathematical way to pay that back. None. The only options are default, which would destroy the dollar's reserve currency status, or inflate it away, which destroys purchasing power. And the central banks know this. That's why they're buying gold. Because gold is the only asset that has no counterparty risk. It's not someone else's liability. It doesn't depend on a government's promise or a central bank's credibility. It just is. And in a world where trust in institutions is evaporating, that matters more than ever. Let me tell you about what's happening in the physical market right now. Premiums on physical gold coins and bars have been elevated for months. What does that tell you? It tells you that demand for actual metal, the stuff you can hold in your hand, is outstripping supply. People aren't just buying paper contracts. They want the real thing. They want it in their possession. Because they understand that in a crisis, paper promises don't mean much. The LBMA, the London Bullion Market Association, which is the center of the global gold market, has been seeing unusual flows. Large quantities of gold moving from west to east, from London vaults to Shanghai, from New York to Singapore. This isn't random. This is a systematic repositioning of physical gold away from Western financial centers and into Asian vaults. And when you combine that with central bank buying, you start to see a pattern. Here's something most people don't know. The gold market operates on an unallocated basis for most transactions. What does that mean? It means when you buy gold through most banks or dealers, You don't actually own specific bars. You own a claim on a pool of gold, and that pool is leveraged. Multiple people have claims on the same gold. It works fine as long as everyone doesn't ask for delivery at the same time. But what happens when they do? We got a glimpse of that in March 2020. When COVID hit and markets went haywire, the gold futures market nearly broke. The spread between futures prices and physical prices blew out to unprecedented levels. Why? Because people wanted delivery. They wanted the actual metal, and there wasn't enough to go around. The system almost seized up. The exchanges had to change the rules, allow different types of bars to be delivered just to keep things functioning. That was a warning shot, and the central banks saw it. That's when their buying really accelerated, because they realized that in a real crisis, paper gold is worthless. Only physical matters. Now let's talk about what's happening with the dollar. The BRICS nations, Brazil, Russia, India, China, South Africa, have been openly discussing alternatives to dollar-based trade. They're not just talking about it, they're implementing it. China and Russia are settling oil trades in yuan and rubles. India is buying Russian oil in rupees. Saudi Arabia, which has been the cornerstone of the petrodollar system since the 1970s, is now accepting yuan for oil sales. This is a seismic shift. The dollar's dominance has been based on two things: military power and the fact that oil is priced in dollars. If that second pillar crumbles, the demand for dollars drops. And when demand for dollars drops, all those trillions sitting in foreign reserves become a problem. What do countries do with dollars they don't need? They convert them to something else, and increasingly, that something else is gold. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties, how the process actually works, what the real costs are. Worth checking out if that's relevant to your situation. Anyway, back to where this is headed. The Federal Reserve is in an impossible position. They've got inflation that's still running hot despite what the official numbers say. Anyone who buys groceries or pays rent knows the real inflation rate is much higher than what the government reports. But they also can't raise interest rates too much because the government can't afford to service the debt at higher rates. They're trapped. And the only way out is to print more money, which means more inflation, which means gold goes higher. Look at what happened in the 1970s. Paul Volcker had to raise interest rates to 20% to break the back of inflation. 20%. Can you imagine what would happen to the economy, to the housing market, to the stock market, if rates went to 20% today? It would be complete devastation. The government literally cannot afford to do what's necessary to stop inflation. So they won't. They'll keep printing. They'll keep inflating, and gold will keep rising. Here's another piece of the puzzle. Mining supply is declining. The easy gold has been found. New discoveries are rare. Existing mines are getting deeper, more expensive to operate. The all-in sustaining cost for many gold miners is now above $1,500 an ounce. That means below that price, they're not making money. They're not going to increase production if they're not profitable. And without new supply coming online, any increase in demand pushes prices higher. And demand is increasing, not just from central banks, from individuals, from institutions, from countries that are looking at the global financial system and deciding they need insurance. Gold is that insurance. It's the asset you hope you never need but are grateful you have when things go wrong. Let me paint you a picture of what happens next. We're already seeing the early stages. Gold has been hitting new all-time highs, not because of speculation, not because of some temporary fear trade, but because the fundamentals have shifted. The supply and demand dynamics have changed. The trust in fiat currency is eroding, and once that process starts, it's very hard to stop. Think about what happens when the general public catches on. Right now, most people aren't paying attention to gold. They're focused on stocks, on crypto, on real estate. But when inflation really starts to bite, when people see their savings losing purchasing power month after month, they're going to look for alternatives. And gold is the oldest, most trusted store of value in human history. When that shift happens, when retail demand kicks in on top of central bank buying, on top of institutional accumulation, the price is going to move in ways that shock people. We're not talking about a gradual increase. We're talking about the kind of move that happens when everyone realizes at the same time that they need to own something real. The commercial banks know this. That's why they're covering their shorts. The central banks know this. That's why they're buying at record levels. The question is, do you know this? And more importantly, are you positioned for what's coming? Because here's the thing about these major shifts in the financial system. They don't happen gradually. They happen suddenly. Everything seems fine, and then one day it's not. One day there's a crisis, a bank fails, a currency collapses, a government defaults, and suddenly everyone wants gold at the same time, and there's not enough to go around. Look at what happened in Cyprus in 2013. The banks closed. People couldn't access their money. When they finally reopened, there were capital controls. You couldn't take your money out of the country. You couldn't even withdraw large amounts. Your money was trapped. And the government took a percentage of deposits over a certain amount to bail out the banks. That's called a bail-in, and it's now official policy in most Western countries. Your bank deposits are not as safe as you think they are. In a crisis, they can be frozen. They can be confiscated. They can be inflated away. Gold can't be. Gold in your possession is yours. No one can take it. No one can devalue it. No one can freeze it. The central banks understand this at a visceral level. That's why they're repatriating their gold. Germany brought hundreds of tons back from New York and Paris. The Netherlands did the same. Austria, Belgium, others. They want their gold in their own vaults, under their own control, because they know that in a real crisis, possession is everything. And here's what should really concern you. The derivatives market. There are hundreds of trillions of dollars in derivatives contracts tied to interest rates, currencies, commodities. These are essentially bets on the direction of markets, and they're all interconnected. When one part of the system breaks, it can cascade through the entire structure. We saw this in 2008 with mortgage-backed securities. The next crisis could be in sovereign debt, in currency markets, in the gold market itself. When that happens, when the derivatives start unwinding, the demand for physical gold is going to be unlike anything we've seen. Because gold is the ultimate safe haven. It's the asset that survives when everything else is burning. And the people who own it, who have it in their possession, are going to be in a very different position than those who don't. The gold-to-silver ratio is another indicator worth watching. Historically, it's averaged around 15-1, meaning 15 ounces of silver equal 1 ounce of gold. Right now, it's much higher. That tells you silver is undervalued relative to gold, but more importantly, it tells you that when gold moves, silver is going to move even more dramatically, because silver has both monetary and industrial demand. And in a crisis, it's the poor man's gold. It's what people buy when gold becomes too expensive. Let's talk about what this means for the average person. If you're holding cash, you're losing purchasing power every single day. The official inflation rate might say 3 or 4%, but your real cost of living is going up much faster. Your dollars are worth less every month. And that's by design. The system is built to inflate. It has to inflate to service the debt. If you're in stocks, you're exposed to market risk. Yes, stocks can go up, but they can also crash. And in a real crisis, when liquidity dries up, you might not be able to sell at any price. We saw this in March 2020. Circuit breakers were triggered. Trading was halted. People couldn't get out. If you're in bonds, you're facing interest rate risk and inflation risk. If rates go up, bond prices go down. If inflation stays high, your fixed income gets destroyed. You're locked into a return that doesn't keep pace with rising prices. Real estate has its own issues. It's illiquid. You can't sell a house quickly if you need cash. It's expensive to maintain. It's subject to property taxes that keep going up. And in a deflationary crash, real estate can lose value fast. Gold is different. It's liquid. You can sell it anywhere in the world. It has no counterparty risk. It's been money for 5,000 years. Every civilization that's ever existed has valued gold. That's not going to change. And in times of crisis, it's the one asset that consistently holds its value or increases. The central banks are sending you a message. They're telling you, through their actions, that the current system is not sustainable. They're preparing for a reset, a restructuring, a fundamental change in how the global financial system operates. And they're making sure they have gold when that happens. You need to ask yourself a simple question. If the people who run the monetary system are buying gold at record levels, shouldn't you be doing the same? If the institutions that have the most information, the most resources, the most sophisticated analysis are accumulating physical metal, what does that tell you about where we're headed? This isn't about making a quick profit. This isn't about trading. This is about preservation. This is about making sure that when the system resets, when the dust settles, you still have wealth. Real wealth. Not paper promises. Not digital entries in a bank account. But actual, physical, tangible value. The warning has been sent. The central banks have made their move. They've shown you what they're doing. The question is, are you going to pay attention? Are you going to act? Or are you going to wait until everyone else figures it out and it's too late? Because that's what happens in these situations. Most people wait. They wait for confirmation. They wait for the mainstream media to tell them it's okay. They wait until their neighbors are doing it. And by then, the price has already moved. The opportunity has passed. The gold is gone. The smart money is moving now. The central banks are moving now. The question is, will you?